welcome back to my video. As usual, I will introduce myself. My name is Indang Sartika. I am a student at Mercubuana University, especially in major in accounting. I made this video to complete the 7th forum of English for Accounting class, and in this video I will explain about balance sheet statement. Okay, let's get started. In this video, I have 3 important points. 1. Balance sheet. 2. Concept of balance sheet. And 3. The accounting criteria and formulas. Okay, we start from balance sheet. Balance sheet is summary of the financial balance of an individual or organization, whether it be a sole proprietorship, a business partnership, a corporation, and private limited company or other organization such as a government or not-for-profit entity. The balance sheet shows the composition of assets and liabilities, the relative proportion of debt and equity financing, and how much of a firm's earnings have been retained in the business. Balance sheet, especially when compared over time and with additional data, provide a great deal of useful information to those interested in analyzing the financing well-being of a company. Of special interest to both creditors and investors in analyzing the balance sheet is the company's financial flexibility. B. Concept of balance sheet. Balance sheet, in case of a non-trading concern, is prepared in the usual way and contains particulars of all assets and liabilities of the concern or institution on which is prepared. The excess of asset over liabilities is termed as capital fund or general fund. The capital fund is made up of income over expenditure and other income or surplus which might have been capitalized by the institution from time to time. Sometimes the balance sheet may have to prepare. 1. Balance sheet in the beginning of the accounting year to ascertain the amount of capital fund in the beginning of the accounting year, and the balance sheet at the end of the accounting year to show the financial position and the institution as on that date. Okay, next, elements of the balance sheet. The balance sheet addresses two following accounting equation with asset on one side and liabilities plus shareholder equity on the other. Balance of asset, liabilities plus shareholders equity. Okay, first, asset. Asset are the resources that a business uses to operate its business, such as cash, inventory, land and buildings, and equipment. Essentially, assets are any items of value owned or controlled by the business that contributes towards generating revenue. Assets are categorized as either current or non-current assets. 2. Liabilities. Liabilities are the financial obligations or debts of the business and include claims that creditors have on the business, research such as account payable, bank overdraft, provision for employees, annual leave and long service leave, tax liabilities, and loans payable. Essentially, liabilities are amount owed by the business to external parties. Liabilities are categorized as either current or non-current liabilities. Okay, next 3. Owner equity. Equity represents the amount belonging the owner once all financial obligations have been met. Equity includes the initial and ongoing capital investment made by the owners. Retained earnings or accumulated loss and reserve. Capital is any cash or asset the owner has contributed to the business. Retained earnings are any profit that are reinvested in the business. Reserves are profits set aside for particular purpose such as asset replacement or major building maintenance. Next, C. The counting ratio and formulas. Counting ratio are used to describe the relationship between amounts or figures shown in either balance sheet, profit and loss statement, or any other financial statement document which is part of an accounting organization, thereby aiding financial analysis of the company and depicting its performance level. Types of accounting ratios. There are various types of accounting ratios used by various interest stakeholders to analyze the financial statement of the company. All the accounting ratios can be applied bifurcated into 4 different categories as stated below. 1. Liquidity ratios. The main objective of any liquidity ratio is to measure the company's short-term solvency status of the company. It states the company's efficiency and capability in paying off its current liabilities and debts by utilizing its current asset. The formula to derive the aforementioned ratios are given below. Two, profitability ratios. Profitability ratios measure the company's capability and efficiency in utilizing its capital in order to generate revenue and ultimately profit, generally represented in present terms. It represents the relation of the unit in terms of percent of sales. The formula to derive the aforementioned ratios are given below. Activity 3. Activity ratios. Activity ratios the company capability of managing and converting its asset into revenue and cash. It shows the company efficiency in utilizing its asset and in order to generate revenue. The formula to derive the aforementioned ratios are given below. Next, last, leverage ratios. Like liquidity ratios are used to understand the company's short-term solvency aspect. Average ratios help in determining the long-term solvency aspect of the company. Okay, the formula to derive the aforementioned ratios are given below. Thank you so much for your interest and attention. See you in my next video. Bye bye.